Yes, go ahead. Start the
Okay,
game.
welcome to WellHub. So today we are going to present to you how to use fair value gap in trading. And in today's class, we are going to present to you two ways of how to identify a fair value gap. We are going to do the manual way, and also we are going to do the automated way. Okay, so follow me, and I will encourage all of us, just like the leaders of this WellHub have already recommended, we should move from theory to practical. So I will encourage every member of the WellHub that are attending this training today to please switch on their tablet and open their trading view. We use trading view for analysis. So having opened your trading view, so you need to first of all identify the trend of the market when you want to trade with your fair value gap. So identify the trend of the market. So in identifying the trend of the market, you come to where you have all the icons or the symbols or the signs. Then you pick your fair value gap. Sorry, guys. You pick your trend and draw your trend line, as we have seen here in this green line. Assuming you are not comfortable with the green because the bars of the charts are green, so you click on the trend line, and then you can as well change the color to, let's use something like orange. So let's change the color to maybe blue. Aha, perfect. Okay, so we are going to use blue trend line. So you draw the trend line, and the rules in drawing trend line is that your trend line must touch at least two candlesticks. So depending on the candlestick that you are choosing or you are drawing above, so it could be the wick of that candle, or it could also cross the body of touch the body of that candle. So looking at this blue trend line, it has touched three of those candlesticks. So meaning we have first of all met the rules of drawing a trend line. So the next thing for you to do is for you to look at the chart and then identify the bullish or the impulsive move in the market. The impulsive move in the market is identified by the length of that candle. So if you look at it here, so you can see some impulsive move here. If you are seeing my cursor, here we have an impulsive move. Here we have an impulsive move. We have an impulsive move here. We have an impulsive move here. We have an impulsive move here. So it is not, note please, it is not all the impulsive moves that result in creating a fair value gap. And what is a fair value gap? It is a gap that is created by the movement, the momentum in the price movement, that is either on the buyer side or on the seller side. So that takes us to what we refer to as the BC. BC means buyer side imbalance and sellers insufficiency. That's BC, BISI. So that is when you are on the uptrend, which is the buyer trend movement. So here now we want to identify the candles. So you look at the candles, where the candles in a normal chart, the candles, the three candles will always overlap each other, either by the wick or by the body. But where you see there are no gaps, there are no overlapping occurring in the candles, in three candles, when there's an impulsive move, therefore means that you look out for a gap that is identified. So now we want to identify the gaps here. We want to look at the candles. So you now see there's a candle here. We're looking towards the current trend of the market. So you see the impulsive move. So you see this candle. So you see the big impulsive candle, and then you see the third candle. So we are going to consider in considering fair value gap, you always look at the three candles. So we want to mark out where the candles end. So you come back to your trend line, and then you look at it. You can zoom in. So this candle has very tiny, more or less a no wick. So you mark out, you draw there to know the end of or the height of that candle. That is the BC. the first candle. So we now move to the third candle, not the second candle. You come to the third candle. So this is the third candle. The third candle has a very small wick. So we draw it at the bottom of that wick. You draw it at the bottom of that wick. Please take note, we are considering this first candle. I hope you can see my cursor. And then we are considering the second candle and the third candle. These are the candles that we are considering. So we take the height of this and we take the bottom of this. So this space where you see here is what we call the fair value gap. So now, how do you trade the fair value gap? Once you identify the trend, which we have said, once you identify the trend that is an uptrend, you know that whatever happened here, it was the struggle between the buyers and the seller took over. So the buyers will always find a way of also entering the market and battling the market. And that will definitely bring back the impulsive move into the market. So it will bring out a reversal or something like a retracement into it. And the rules of trading the fair value gap has it that market will always find a way to tap into the fair value gap before continuing the trend. So now, Ezekiel before now talked about high probability trade and all that. So I just want to add that once you identify your fair value gap, the bottom line is called the discount low. This one is called the discount low, while the upper one, the upper band, is called the premium high. Please take note of this. While you want to identify a, a, um, a high priority trade or entry point when trading a fair value gap, you need to identify the low discount band and the high premium band. So the high premium band is the up one, and the discount low band is the lower one. Okay, so I will change the color so that we can go along with what I'm saying. Okay, so the orange color, depending on your color preference. So the orange color here is what we refer to as the premium high band, and while the red uh, color is the discount low band. I will explain normal buy trend, which is an uptrend. Once price might not necessarily tap into it by 50%. So you can look at it once it tap into the higher band, the premium high band, which is this band or slightly below this band, you are good to enter the trade. Okay. Now, when it is on a sell side, when the market is on a sell side and you identify a bearish fair value gap, then you consider market entry from the discount low band. So that is it. So if you look at this trade, some of us took this trade yesterday. So the market, after the third candle, the fourth candle tapped into the premium high band, and the market went up, as you can see here. Okay. So the rules is also is that once you can manually identify the middle of this fair value gap. So I'll change the color so that we don't get confused. So that is the color, that's the middle, which is like 50%. If you are not using Fibonacci retracement, so is it. So the rule also and disrespect this 50%. It therefore means that there is going to be a change in the trend. Okay. And another thing you need to know, just like Dr. Love talked about, she's learning market structure. Another good entry point for you to consider, high probability entry when using fair value gap, is for you to understand the break in structure. If you look at this market, the market came like this. There was a break in structure here. Let me try to mark out the possible break in structure. So there was a break in structure around here. Sorry. There was another break in structure somewhere here. Fair value gap has it that anytime you identify if you are good to go, you enter it with your full chest. You enter it with your full chest. So these are also part of high probability or sniper entry when you are trading fair value gap. Please confirm you can see where I have identified the break of structure. Please confirm.
We can see it.
Okay, that's good. So now, if we moved a little bit higher to where the current market is, you see that if the current market, if the current candle shoot up above this current, the last height here, which was the week, which we can also look at it as a liquidity sweep or liquidity grab, sorry. So if the current market, the current price shoots above here, assuming there's an impulsive move now in the market, there will be a long engulfing candle here, which might take out this week that liquidity grab happened here. So in that case, there will be another change in structure, some break of structure somewhere here. Okay, there will be a sorry, please. There will be a break of structure. There will be a break of structure somewhere here because the last, you see, the last height as at yesterday, I think yes. Let me see. Okay, at yesterday. So the last high of this gold market was on this week. So if there's going to be a change which will signify further upward trend, there must be a break of structure where I have drawn here. So basically, ladies and gentlemen, this is how to manually identify a fair value gap and trade it with all these indicators or with all these signs guides that I have told you. So I'm going to like recap this manual again. So first of all, open your trading view, come to your asset, choose your assets. Here you can see here. So there's a search icon here. So you choose your assets and then keep it on a 1 hour, 1 hour or 4 hour time frame. So whenever you keep it on a higher time frame, the fair value gap that you will identify in a one on a higher time frame is likely to happen. It is going to be a very good fair value gap, okay, what we call original or genuine fair value gap. Thereafter, you come to draw your trend line to identify the trend of the market. So we drew this blue line, which is the trend line, to show that the market is on a uptrend. The buyers are involved. The buyers are in control. Thereafter, you try to look at where do you have breaks of structure. So any fair value gap identified around break of structure gives you very high probability trades. It gives you very high probability trade. So we identified here, and I said manually you use 3 candles to identify your fair value gap. And then in identifying, you see that the first and the third candles, wick or body, does not overlap each other. So that way you are good to go. You mark them out and then wait for the fourth candle, the subsequent candle, and the future candle to tap into either the premium high zone or the low the discount low zone on a CB. CB is the fair value gap that you identify during a sell trend. That is a downward trend. While the BC, which is the buyer's imbalance, seller's inefficiency, is the one that you identify during the uptrend. And I'm also saying that for you manually, for you to know when the trend or the fair value gap is not valid, it is when it breaks the 50% mark. When it breaks the 50% mark, which you can literally see and identify with your eyes, when the market comes up here and it does not respect this 50% and goes down, know that that fair value gap is invalidated. Another thing to know when trading a fair value gap is that make sure that that fair value gap has never been invalidated. So when once a fair value gap is invalidated, meaning that price has come and touched that zone, it therefore means that that fair value gap will no longer be respected. Okay, so that is it. This is the manual way of identifying your fair value gap. So you have questions, you can ask them, write them down in your notepad or drop them down in the chat box. So I'm going to clear my chat too so that I can have a good clean chat. So we now go to the automated fair value gap trading. So I'm going to clear my chat. So watch how my
you want to
cursor
take
is
question
moving.
before you go to the automatic, or you want to take automatic before you take all the questions?
Okay, so let people drop questions or raise their digital hands, and then we can go over it. We can take the questions then before we go to the automated fair value gap trading.
Okay, so let's take questions now so that people can ask before we go to automatic. So if you have questions, please raise your hand. If you have questions for him, raise your hand, and
It's for the
if
group. So
you,
group C can, any member of the group C can answer because we did
okay, so
extensively,
if you
we
have
dealt
questions for
extensively on
them,
this.
if you have questions for them, ask, raise your hand, and if you or you leave it in the, I also I even have questions, but let me take Madam Esther. Madam Esther, please go ahead.
Okay, ma. Please, I want to, you just said something about invalidation of the fair value gap. Please, if you could just give it a recap again. I didn't get that explanation well. Thank you, sir.
Okay. All right, thank you. All right, so what I said about invalidated fair value gap is that if price at any point in time, what fair value gap tells you, fair value gaps gives you like a direction that this is where market will definitely come to again before it continues its direction. So we are considering an upward trend. So you identifying a fair value gap on a higher time frame on an uptrend shows you that market will always come back to tap into that fair value gap in the future. Will tap into that fair value gap in the future. So if market has tapped into that fair value gap, that means that that fair value gap is already invalidated. Is already invalidated. That is one. Two is that if market comes in and disrespect the 50% of the fair value gap, like I drew here, half of this gap is 50%. So assuming now the market taps in here, let me do something here. Assuming this market had come in, tap in here, and this is at this point, it is on 50%, and then disrespected that 50% and comes down here. It therefore means that this fair value cannot go up again. So the whole structure, it also signals the fact that the whole market structure is going to change from an uptrend to something to a downward trend. So that is it. I don't know if you understand me.
Yes,
Hello?
thank you. Thank you very much, sir. I understand now. Thank you
Okay.
very much.
All right. So for the
Do you have
purpose of
another
recap,
question? Okay, which you said you should repeat. Colonel, which you said you should repeat what you said.
Okay, so what I'm saying is that if first, once you identify your break of structure, any fair value gap that happens around the break of structure will be a valid fair value gap, especially when it is when you get your trend right. When you get your trend right. So for instance, where we are choosing, where we just selected to do this illustration, the fair value gaps happened at exactly where there's a break of structure. So that makes it a very valid fair value gap. And what I say here is that in such fair value gap, when you are on upward trend, you identify your premium high zone or band, which is marked by this orange or yellow line, and then the discount low band, which is identified or marked by this red. I change these colors, please. I change this color for illustration purpose. And price will definitely come to test the premium high band, and it might touch it, it might kiss it, it might go below, but it might not necessarily break the 50%. Listen, it might kiss it just like this one. You saw it kiss, the wick kiss this high premium or premium high line of the fair value gap we just drew. It kissed it, and immediately it kissed it, price has always been on the upside. So that is it. So if it kisses it, it enters and even stop at 50%, but does not break below 50%. That means it is valid. That's what it says. So, but where price come, kiss it, test it, and continue going, you don't have hope on this fair value gap again. That is to say, it has invalidated it. I hope it is clear now.
Very clear.
Okay, yes, I have my question. Shadows have finished their question. Okay, Mary, your hand is up. Let me take others first. Mary, ask your question.
Thank you so much. Thank you, Uncle Eden, for the presentation. It's well explained and understood. But my question is this: what you just said, you made mention of discount low band. At what point now can you now set your entry and your take profits if you identify the fair value gap? That's my question. Thank you.
Okay, thank you very much. Okay, so now what you do is that once you identify your fair value gap, now remember that the candle just formed here, the third candle that gives you that confirms that a fair value gap has happened is always the third candle. So you count with me. This is candle 1, candle 2, and candle 3. So once candle 3 is formed, looking at your chart, your naked chart, like I said, that is why I had to do the manual way of identifying a fair value gap. So once you see an impulsive moved, and then you now try to check the candle of the first one and the candle of the second one that serves like a border or a boundary for the impulsive move, then you can now see where the wick or the body of the candle ends. So if it does not overlap, you know that fair value gap has happened there. And then from this fourth candle, you can enter your what do you call it? You can enter your market. You can enter your market and set your stop loss slightly, maybe below the 50 mark. You understand? So you can enter the market and set your stop loss below the 50 mark. Remember, I have said that when once price or the market comes back, hits the 50% and go down, it therefore means that it will no longer respect that fair value gap. Okay? But using Fibonacci, you can put it below here, which for me, this is my personal, in terms of risk management and capital protection, I will not put my stop loss there. I will put my stop loss knowing that anytime price retraces and go below 50%, that fair value gap is likely not to be respected. Let me just use that English. It's likely not to be respected. It therefore means that it will go against you. So for me not to have so much loss, if I put it below here, for me not to have so much loss, it's better the market takes me out after 50% or below 50% than rather than it taking me below after the first candle that it produces the impulsive move. Do you understand? So that is it, man. And then you can take your, you can put your stop, take profit way up here using maybe 1:2 ratio or 1:1.5 ratio or 1:1 at most, or at least, sorry. So that is it.
Thank you.
I
Yes,
hope
you
I
have.
answered
Thank
your
you. Thank you.
question,
Thank you. I
Madam
really
Mary.
understand. Thank you so much.
Zika, I'm gonna see you.
All right.
My question.
Dr. Olaf, one
Yes, ma'am.
question. Somebody said, ask question on take profit. Since he's doing stop loss, let him just also identify entry
Okay.
and take profit. I think I saw that flash. Then we
So
you
why
know,
are we supposed to
now,
take trade?
Professor.
Okay. Somebody said, why are we supposed to take trade? Okay.
Yeah.
Okay, so
Since we
now
have
let
not
me,
stopped, Mr. Eden,
okay, yeah, I
Mr.
heard you, ma'am. I'm
Answering,
going,
in answering that EP, also answer the TP so that the three is complete, EP, SL, and TP. Thank you, sir.
okay, ma'am, thank you very much. So if you're on your trading view, we encourage people to use their trading view and then do justice to their this thing. So because you want to take a buy trade, so please look at where I come to click. This panel is a guide that you use your tools in manipulating or maneuvering or navigating your trading view. So if you come to this one, so you count from the first one, this one is cross, the second one, the third one, the fourth, what you use in taking your doing your focus, doing every other thing that has to do with price and the rest. So you take long because you want to buy. So you come here and place it. So when you place it, so like I said, so you put, sorry. Okay, so this is it. So like I said, for me, I will put my stop loss slightly below the 50% mark. Slightly below the 15% mark. And I might take my, so you can enter your, once, because you are on your chart. So once the fourth candle comes and tap into let me take this, let me take this out and this candle. So once you have mapped out your this thing, so you can as well, first of all, put, it is two ways anyway. So you can as well put your this thing like this, and then take your entry slightly below what do you call the premium high band. Okay, you can take your entry slightly below the premium high band, and I will explain why. Remember, price, what do you call it? Yeah, price. will always come on a buy side, will always come either keys, test, or enter through the premium high band, which I have marked yellow here, which is yellow or orange, depending on your choice of color. Okay, so you take your entry will be slightly below there, or you can put it slightly on top. So that will be your entry price. And then your profit, you can now do 1:2, or you can do 1:1. And then your stop loss, like I said, I will put my stop loss below, slightly below the 50 mark, FVG. Understanding the fact that when once market or price come to 50%, there's a high probability that the market is not going to buy up again. So it might definitely or likely reverse, not definitely reverse. Dr. Dupe.
Yes, please.
Hello, people. Leaders of Wealth Hub, please confirm you are hearing me and my explanation was
We
clear.
can hear you.
Yes. Hello.
I said
Yes,
we
we
can
can
hear
hear
you.
you.
We can hear you.
Sorry,
Somebody
please confirm
come.
you heard me and everything went on well.
Confirmed,
We
sir.
can hear you. We heard you.
Yeah, I want to know
Yes,
if
I
you
think
heard the
she said
explanation
good
and if it
explanation.
makes sense.
Thank you, Mr. Eden. That was a good explanation. You know, Dr. Love will still post
Okay,
this.
that's fine.
The reason I said do it together so that you knock it off and then we'll move on to something else.
Okay,
Yeah.
so I have my question. Please go. What? Yeah, you stop sharing.
I will share again. Sorry, don't mind me.
Continue to share.
I,
Because I have a
I
question
will
on that.
Yeah, so don't mind me. I wanted to be sure because I was not seeing the Zoom. I wanted to be sure if my network knocked me off. I'm the only one in the meeting. Okay, the screen is back. Confirm you are seeing the screen.
Yes, I can see the screen.
Dr. Love, please. Okay, go ahead,
Okay,
ma'am.
2 questions. My question was 1 before, but this last explanation are 2. Now, I am looking at this chart that you have now.
Yes, ma'am.
And I've read that book, and they said when 3 candles, imbalance. What this chart where you are now? Where you
Yes,
one that you have
ma'am.
explaining the fair value gap. If you and the line that has gone down. This other green one also. Can you see this other green one by the left? No, that's right, to the left. Where this line and that green line, I am not seeing any difference. Are you saying that's also a fair value gap? Because honestly, I still can't identify fair value gap on the chart. I still need that. Show me. I don't understand. I never understand.
Okay, ma. Let me explain again. Okay, so I'm saying that first, for you to identify a fair value gap, you must be able to, first of all, know the trend of the market. And for you to identify the trend of the market, you come to 1 hour, a higher time frame, either a 1 hour or a 4 hour. And then you use your trend line. You use your trend line to draw. And the rules of drawing trend line is that at least it must touch at least 2 candles, be it the wick of the candle or the body of the candle. And I just drew this now, which I've just drawn again. So, and it touches like 3. So this is 1 here, it touches 2 here, and it touches 3 here. Okay. The next thing is for you to identify the breaking structure. Okay. I marked out the breaking structure here. I mark out the breaking structure here. And I said that if something happens and this market goes up above this wick here, there will be a break of structure here. But we see that this candle is going down. So, but that is fine. Having understood that, you now use your naked eye to look at where there were impulsive move in the market. Impulsive move is identified by the length of the candle. Impulsive move is identified by the length of the candle. So I will delete this and then put them back so that for the purpose of understanding. So impulsive move is identified by the length of the candle. So if you look at this candle, let's start from the left side of my chart where I have my first BOS. There was an impulsive move here. Madam
Yes, I'm
Love,
following.
Dr.
Yes, yes, I'm
Love,
seeing.
please
I'm following.
confirm.
Yes,
Madam
I'm
Love,
following. I'm following. I can see the impossible move. I can see what I'm following.
from the left, I'm coming where you have the first BOS. Yes, okay, the first BOS here. So there was some level of impulsive move here. You are able to identify, I'm not talking to you personally now, to identify an impulsive move in the market. The next thing, since you are looking out for a fair value gap, the next thing to do is that after that impulsive move, you check 3 candles. Check the first candle, you check the height of that candle. You go to the third candle and check the bottom of that candle. If you check the height of the first candle and the bottom of the third candle and see with your eye if there was no overlap. If there was no overlap, it therefore means that there is a gap. So that market, the buyers took control and they created that gap. So that gap now becomes a fair value gap. So for me, I want to identify a fair value gap manually using my trend line. So I use my trend line to mark. So I want to come to this side that is very visible so that we don't need to squeeze our eyes. So that is the first candle. That's the first candle, red doji candle. And now come to the third, that's my candle number 1. I come to my candle number 2. I come to my candle number 3, another doji. I mark the bottom of that candle. I mark the bottom of that candle. This is the height of the first candle. And I'm saying that this place, because there is no overlap of the candle, the candlestick of the third and the first candle. So this gap here could be referred to as a fair value gap. Okay? And I say that if market comes back, it can test it. But in real sense, this might not necessarily be a good fair value gap because there's the third candle, this candle, there's an overlap. And go to the one that we're using. So we come here. So this is the third candle. There's an impulsive move, and this is the first candle, impulsive move, and then there's a third candle. So you use your trend line and mark it. The bottom of the third candle. You mark the height of the first candle. You can mark it and then adjust it. So this candle has very tiny wick. So this space now, because there is no overlap here. So this, the third candle, the wick stop there. The first candle, the wick stop there where we mark. So this body, there's no wick coming here. The wick of the third candle did not come here. into this space of the second candle. The wick or the body of this first candle did not come into this space of the first candle. So that space is a fair value gap, ma.
Okay, please let me ask my question like a baby, like a primary school baby.
Yes, ma. Go ahead.
Because I've been racking my brain about that overlap. Okay, so what you're saying is that what you mean the overlap is that this line, if assuming it goes a little bit up into the other one, that's what you mean by when you're saying there's no overlap.
Okay, ma. I will do a small drawing. You see this third candle. This third candle, ma. If this third candle had a wick like this,
Okay.
and then this first candle had another wick like this.
Okay, so now I understand this.
So meaning that the first candle and the third candle have overlapped this second candle. So there's no gap.
Oh, yes. Now you people are speaking my language. I don't rack my. I know girls understand this in our language.
So I
It's now
believe
it's making
everybody too
sense.
will understand. So once there is this not the market does not present candles like this, then it therefore means that there is an overlap. That's the manual. There's no overlap.
Okay.
Sorry.
There's no
If it does
overlap
not
now.
present the candles or the body, this overlap can be a body. It can also be
A week.
a wick. Now take for instance where we were trying to draw before. You see that here there's a doji here. There's a green doji here, which is an indecision candle. You see that the body of the wick, the body of the candle came down to almost the edge of that this thing, and the wick also came again. So there's like if you look at these two candles, there's no overlap. Then you come to
Oh,
this red bearish candle.
candle.
You see, it is almost at the edge, and then there's a wick again. So this
Okay.
doji had come up here. The wick of this red also came down. So there is no gap. So it has overlapped. The three candles here have overlapped themselves. Let me use this small. Oh, sorry.
Okay. So now I understand this in our language. Thank you.
Is that okay, please, everybody?
Yes. Yes, I'm fine now. We cannot go to.
Okay.
Now I understand like a baby. Thank
Yes,
you.
so we
Can
all
I
we
go
all
to?
understand though.
Oh, so some people did not understand. They did not ask until Dr. Love asked. Okay, so now let's go back. This is the manual type, and I want to re-emphasize again, for you to have a good sniper entry, anytime the feed candle, anytime the future candle touches I call this the upper band, where we marked the low of the third candle. I call it a premium high band, while the low is the discount low band. And it is said that when you want to take a high probability trade, look for whenever price come to kiss this line, upline, for a buy trade. But for a sell trade, when price come to kiss, touch, or enter a little, but not up to 50, but up to 52 is okay, is accepted. Okay, up to 50, that's to say half of this band, half of this gap is 50% of the fair value gap. So that is it. So you
Okay,
enter your
my
trade.
second question. Sorry,
Yes, ma'am.
when you were explaining when to put stop loss and take profit, can we not
Yes.
just do simple 4-to-1 like which you taught in this 4-to-1 ratio? Can we also just use that for our stop loss and take profit here?
1-to-4 ratio, right?
Yes, 1-to-4
Now,
ratio.
yeah, 1-to-4 ratio is that for this particular trend, why we cannot use 1-to-4 ratio, let's look at history. In recent, just because you want to protect your capital and manage your risks very well, if there was, for instance, let me see if I can do something for the purpose of learning. Sorry, please just pardon me. Let me try to check something, a tool that we can use. Okay. Let me see. Kind.
Sorry, Mr. Idem, I don't know if I can add to that, sir.
Okay, but let me just explain this. Assuming, everybody please just pay attention. Looking at the left-hand side of the chart, assuming it was a sell trend, the market was coming down. Look at where I'm trying to look at the arrow, the icon I can use. Assuming the market was falling from this side where my cursor is, and then suddenly it began to come up. It was a sell trend. A sell market, and suddenly the market start to reverse with a break of structure. In that case, you can use that 1 to 4 and then target the opposite height of the last height when it was a sell trend. I think that's the little of my own knowledge. So Ezekiel can come in here. Over to you, Ezekiel.
All right. Thank you very much, Professor Idem, sir.
No,
A very good
you.
one. A very good one. A very good one. Okay. Rich Bandega, 1:4 risk to reward ratio. The more perfect you're getting on the daily basis, that is what the determinant of your risk to reward ratio. So it is not cast on stone that rich, even the rich that said 1:4 ratio said target 1:1 first and break even. So if it doesn't deliver 1:2, call it a day. If it doesn't deliver 1:3, call it a day. But 1:4 is what is aiming as his total target profit and is on a lookout for 1:1. Like if it gives him a 50% profit, he takes that and break even. So for any reason, market, of course, as we say, high probability, probability is probability. It will want to go your direction and it may not want to go your direction. So in case it's coming back, if you have taken 1:1, enjoy it and it is still a good trade and you are still profitable. So don't really bug yourself on 1:4 yet. No.
Okay, Ezekiel, sorry, I'm not. I'm just using
No,
that, but that's my strategy name. But it's those. I'm just trying to look at that 1:1, 1:2, 1:3. But I'm just calling it 1:4. It means that I can do 1:1 because the what he used in
yes.
explaining, I know grab am. But me, sometimes 1:1, I don't come market 1:2. So I'm just using that as my strategy name. Actually, do you understand what I'm
You know,
saying?
the more you are perfecting it, you know you'll be knowing, you get to be knowing, okay, 1:1, happens for me more frequently, or 1:2 happens for me more frequently. So
Okay.
as you journey along, you'll be knowing what happens for you more frequently. But check out for your next support. Your next resistance. If you are pursuing, a buy market, check out for your more strong next resistance and you're expecting a reaction from them. So that reaction might change everything in the market. All right. But at least your setup is beautiful and you're already in the market and hoping for profit. All right. Thank you. Prof, please go ahead, sir.
Okay.
Then we have Dr.
Okay.
Duper sound. We have Dr. Duper sound.
Okay.
Thank you
Go
so
ahead, please.
much. Thank you so much, Mr. Idem and Group C. Mr. Ezekiel just took out what I wanted to say, but yes, remember from the beginning of this class, Mr. Ezekiel was talking about us having the class for execution and high probability. I will say that you have taken us to Jericho and everywhere back and we are here. So Mr. Ezekiel, please start to plan for this, yes, but Mr. Edem, you have talked about stop loss, you have talked about entry, you still did not talk about take profit. The reason I'm saying this is when we have review of all of this, people go practice these things. So you need to show them where to put their take profit. I know we have been doing it because this is recorded. Some people might not have watched the first one where Ezekiel and Chairman did that. So I would like you to just go back there. You have identified value gap, BOS, how to identify it and all of that, what the week is saying. You have shown where to put your stop loss. You have shown where to put your entry. Can you show people how to also? So I am a fan of where he's gone now. We also need to look at 20 up 20 that take profit and trading at 20 pips up or 30 pips up or 30 pips down. Let people have that idea, because I see new people here today, so that by the end of this week, when we are wrapping up, we've gone around it and fair value gap is understood as our entry. I see say you don't talk sniper entry, we will come to confuse. So when we get to Ezek's suggested topics, that we're not going to come mix Gary and beans together. Thank you, sir. I really love your presentation.
Thank you, Doctor. If you guys were not here, then this class wouldn't have been complete because I look forward to all the leaders they were up. And for me, I must confess, this is a place to be. I've learned a lot. Just like Ezekiel said, basically, because you are just entering a trade, your what you call it, your stop loss, your take profit would definitely be around a resistance zone. Hello, Chairman, go ahead. A resistance zone. Chairman, go ahead, please.
All right, Mr. Adam, can you hear me?
Yes, I can hear you loud and clear, sir.
Okay, you have done very, very well. Your trading view very clear. In fact, this is excellent.
Thank you, Chairman. I learn all from you guys. Thank you very much.
Excellent. No, I should be learning. I'm learning from everybody. That's why I joined. No man is an island. Nobody knows it all. So I join and I learn from everyone. Yeah, but I think to Dr. Duper's question, I think you've already addressed the issue of take profit. You've already said take profit ratio 1-to-1, ratio 1-to-4, and you use the long to indicate that. Yeah, I think you addressed that. Then Ezekiel now added the previous resistance. And you have also even marked it. You can see what you just marked now. Price came back, tapped into the previous block that created this drop. No, this is like mitigation. Price came back to mitigate, and you can see where the sell commenced from. We could have taken that sell, but I didn't want us to break your flow. I'm sure some people saw it and they would have taken it. So you have done very, very well today. Can you still hear me?
Yes, I can hear you loud and clear, sir. I can hear you very well, sir.
Okay, my network is a little bit unstable. That's why I've been asking, can you hear me? But I want to do a quick announcement before my network goes. I want to do a quick announcement before my network goes off. I had challenges with my announcement. I think you've done justice today. We can continue tomorrow. Dr. Love, please, can you stop the recording at this point? We've done over an hour, 30 minutes.